most vital part of the success of that company is with those employees. So again, whether you have one person that you feel is the person responsible for a big portion of the success of your firm, the problem with most business owners is retention. And retention has become this massive thing that's going on right now when you're talking to any of the business owners that we're talking to. We've been hearing that very consistently, that retention is one of the biggest problems. As a matter of fact, one of the hospitals that we're having a conversation with, they had a big board of directors meeting, and they had all their stockholders in. And one of the questions that came up in the question and answer section to the head of the hospital said, what is the biggest concern that you have in the year going forward? And he said retention. And that's not just in hospitals, that's just about across the board. And that's really because what's happening to us now is a lot of these baby boomers are retiring. We've got less and less people in the workforce taking their jobs, or what I would call qualified people in the field. If you look at the current companies that are in the marketplace today, 40 to 80% of gross revenues are being spent on employee salaries, employee benefits, and most of the benefits that we're familiar with are health insurance and 401ks. So here's what the biggest problem is. If I go out and I'm competing with somebody that's in the same type of business that I'm in, right now we all look the same. There is nothing that sets us apart. Pretty much I know I'm offering a similar salary because we're all looking up the salaries online and we're trying to figure out, what is the normal pay to pay, somebody that's qualified as an attorney or a CPA or whatever that area is. So we know what that is. And then it really comes down to a game of benefits. And if you look at most of the benefits that are being offered today, they all look the same. Everybody's got health insurance, everybody's got 401k, and everybody has some kind of variation of the same. Everything is same old, and nothing has changed in the employee benefit field in years. As a matter of fact, Dane and I went out to an employee benefits presentation, and the whole presentation for 2 days was supposed to be about employee benefits. And the only thing that was being offered that was different and unique at that seminar was whose software could track the same old benefits better than whose. So there was nothing new as far as the actual benefits themselves that were being offered. So I'm trying to get my slide to click. We're being told right now by Fortune what employers worry about most is retention. And this is saying that is going to be their top priority starting in 2017 going forward. Also, there's a new study out by Future Workplace that found 87% of employers said that improving retention is a critical priority to their organization. So if you're not talking to employers about retention, you're not hitting their hot buttons because they don't want everybody coming to them trying to sell them more benefits. They want people to come to them to solve their problem, and this is a problem. So how do you improve retention? You need to find out what your employees are financially afraid of. Fear has two meanings. You can forget about it and just run away from it or ignore it, or you can face it and deal with it. So let's talk about facing employees' financial fears head on, and let's look at this type of survey because these are all similar. If you go out and you poll the average employee that's working in the workspace today, you will find out that their greatest fears are financial emergencies. So we don't want to put our money away because we're concerned that we might have some type of financial emergency that would require us to access that money. Now, if I put it away in some type of a 401k or some type of an IRA, and I need access to it, I'm going to end up having to pay taxes on it and penalties on it to withdraw my own savings account. And most people don't like that. So it would make sense that the second thing that they're most concerned about is not having enough money saved for retirement. Obviously, if you're not putting it away, you're not saving it for retirement. Now, then when people were asked, what's the third thing that's on the list, they said, again, back to this financial emergencies. What type of financial emergencies are you concerned about that you would need access to your money? Medical emergencies due to illnesses. And then the fourth thing is outliving my retirement savings. If I haven't saved enough, then it would make sense I'm not going to have enough to live my life expectancy. Now, what's interesting about this list, because we're insurance agents, is if you look where death of the primary breadwinner is, it's still in their top financial concerns or financial fears, but it's just very far down that list. And they've got all these other things that they're so worried about that if you're out talking to them about buying life insurance, it's not the most appealing subject and it's not on the top of the list of the problems that they have to solve. And from an employer perspective, they don't feel like these are benefits that their employees would perceive as fantastic benefits. In fact, we know Americans fear unplanned financial emergencies and the inability to afford to retire comfortably more than anything else. So let's address those. 90% of highly compensated professionals said that they would have financial concerns such as death, illness. Are they saving enough to live comfortably in retirement? How much will they need in retirement to cover long-term care costs? And are they going to outlive their retirement savings? So let's just start going down that list. Obviously, it's important because the reason we're so concerned about all our finances is because it happens to be the biggest asset that we have, or the largest asset that we have. Our ability to earn an income is more important than our 401k savings account, than our houses, or any other assets that we have. And you can think about that logically. If you're 45 years old and you're earning a salary of $250,000 a year and you never get a raise, by the time you reach 65, that asset's worth $5 million. Now, what that really means is, if something happens to you in your working years, you're going to have a lot of problems being able to pay everyday expenses, mortgage payments. You're not going to be able to go on vacations. You're not going to be able to save for retirement, and you certainly aren't going to meet any of your retirement goals. So if you think about people's concerns, their fears, it's all surrounded around their finances. And in fact, finances create all of, or 90% of the people that cause the stress that cause people, the concerns that cause people stress. And a huge portion of that has to do with divorce. So financials and your ability to earn an income are one of the most important things that we should be talking about. And this is why employers want to focus on providing benefits that will help them. Now, let's talk about on the protection side and think about the current benefits that are being offered in the marketplace when we're talking about just the protection side. Okay, most companies have some type of health insurance. Some companies offer disability, not very many, but maybe to the top executives. And then the rest of those, probably you don't see those anymore, like life insurance, unless it's like a buy-sell, but typically the owner of the company owns it to replace their key man, but it's not group life insurance like we used to see when our parents were working. Most companies don't offer cancer insurance or accidental death insurance. They might make it available in something the employees can pay, but typically they're not paying for it. And disability is starting to go out the window as well. You're not seeing as many employers offering disability. Mainly, I think a lot of that is because the cost of health insurance has gone up so significantly. So most of the employees are sitting back thinking to themselves, am I really covered for the things that I'm financially concerned about? And also, medical problems have contributed to 62% of all personal bankruptcies filed in the United States. So I think it was Warren Buffett that said nearly half of all Americans are one medical emergency away from bankruptcy. So let's talk about death. Now, are people really concerned about death? Well, yes and no. Yes, they're concerned about death if they're pre-65. So if they're in their working years and they haven't had the time to set aside a large enough nest egg to leave their family so that their family has the ability to pay bills on a daily basis, then yes, they are typically worried about having some type of death benefit. And in fact, 70% of U.S. households said they would have trouble meeting everyday living expenses within a few months if the primary wage earner were to pass away today. However, most people's perception is, if I die beyond 65, who really cares? My kids are gone. My wife and I are in retirement. We've got our nest egg set up. And so I'm probably not so worried about that. So logically, most people's brain says, oh, I'm going to be one of those people that makes it to 65. So I'm not really that worried about death benefit. It's in the back of my mind and I have a little concern about it, but it's not my top priority. And in fact, if you look at people that actually make it to age 65 and don't actually die, that is only 24.5% of people will die prematurely. What people are more concerned about is if they come down with some kind of illness. This is those medical emergencies that they're concerned about. They have no idea if they're going to get one of these things. And if you look at the top diseases from the CDC, you can see the number of people that die of heart disease and cancer and respiratory and accident, stroke, and so on and so on. However, most people are concerned about the top two, which are heart attack and cancer, because those are the top two killers in the United States. Every 43 seconds, someone in the United States has a heart attack. Half of those have at least, half of the Americans out there today have at least one of the three risk factors that create heart disease. Cancer, that's another big one. 1 out of every 2 U.S. men will get some form of cancer. 1 out of every 3 U.S. women will get some form of cancer. And so you can see this doesn't necessarily mean you're going to die from it. This might just mean that you get it and there's going to be some type of time period that you might be out of work, that you had to go for surgery, that you had to do chemotherapy, something along those lines. And that is the medical emergencies that people are concerned about, that they might need access to their money. So now let's go and let's talk about the retirement side of the financial concerns, because again, we were back at, you know, am I going to have enough money to retire? And I'm probably not going to be able to have enough to last a lifetime once I get there. So if you go back to the typical company benefits again, what are the employers offering? Most employers are offering some type of 401k with up to a 6% match. And if you think about the executives now, the guys that are earning $200,000, $250,000, those guys are maxing out their 401ks, and they can only put in $18,000 until they get to 50. And that is not going to come close to solving the problem for them, which is saving enough to live in the current lifestyle they're used to now. Now, a lot of companies have looked at, in the past, deferred comp plans, pensions, ESOPs, SERPs, and so on. And you can see a lot of companies going away from those. As a matter of fact, most people are freezing pensions. Most people are not offering those anymore. Deferred comp, a lot of employers aren't annually funding deferred comps. We've seen so many underfunded deferred comp plans. A lot of companies are getting rid of their ESOPs, or SERPs, et cetera, et cetera. And what you're starting to see now is you're starting to see this big shift over to bonuses. And so if you're just talking to an employer about comparing a compensation program or benefit program against a bonus plan, then you're going to see how well Kai-Zen works in this particular field. So now let's talk about the financial concerns. The average cost of retirement has risen, according to Merrill Lynch, to $738,000. So retirees that are accustomed to high incomes, these are the guys that are earning above $200,000, are going to need to save even more than this just to maintain their current standard of living. Now, you're getting ready to see what this average actually is, because we're not anywhere close to the 738. We also know that the latest statistics say that the average American is only saving about 4% of their income. The top income earners, that's the 1% to the 10%, are only saving 9.8% of their salary. Observation would tell you that if you're 25 years old and you're in that high income bracket and you get a 5% real rate of return, you need to save 13% of every penny of your paycheck. If you're 30 years old, you need to save 18%. If you're 35 years old, you need to save 24%. And if you're 40 and up, you need to save more than 34% of your income. Now let's go back to a 45-year-old who's earning $250,000. 34% of his income is $85,000 a year. How many people do you know are saving $85,000 a year of their paycheck? I can tell you there are very, very few people doing this. Now, let's talk about long-term care. This is the other problem people are concerned about. When I get to retirement, how much am I going to need for long-term care? The average person retiring today is going to have a 70% chance of needing long-term care. And in fact, 40% of the 13 million people receiving long-term care benefits are between the ages of 18 and 64. So we're not even talking about needing this type of benefit before you get to age 65. We're also talking about the need for long-term care services prior to that. Now, Fidelity also estimates that the average couple retiring today is going to need $260,000 to cover medical costs in their retirement. And let's go to the outliving my retirement savings. The total amount being reported today of people that are saving money, less than 17% of the people retiring today have more than $250,000 saved total. Now, think about that when I just said to you that Fidelity is telling us the average couple needs to save $260,000 just to cover Medicare when you've only saved $250,000 total. What are you going to use for your retirement? And to make it even worse, average life expectancy in many nations is on the rise. And if you look at most of the population now, you have people living all the way into their 90s, and we certainly see that as well. So what is the real reason companies are not retaining the top talent? Mainly that's because they are not providing them what they need to protect and grow their most valuable asset, which is their ability to earn an income. Excuse me. Now, let's talk about those highly compensated employees. And if we know 90% of those guys are saying that their financial concerns are about insufficient savings for retirement and making sure they have enough money to cover illnesses or disabilities or long-term care needs, and we're not offering them those types of benefits, then it's going to cost us a lot more money to replace them. Now, unfortunately, this is a double-edged sword, because if you offer them, that means you're signing your company up for a long-term commitment. If this doctor is 45 years old or this employee is 45 years old, that means you're signing up your firm for a 20-year at least commitment on whatever benefit you decide to implement. And if you don't, what it's going to cost you, according to LinkedIn, is 400% of that person's base salary to find somebody else, re-recruit, train, and replace them. So you're kind of damned if you do, damned if you don't. So let's now go back and let's talk about employers and what the benefits are that they're offering today. And imagine an employer that has the ability to offer a lot more than what you're currently seeing today. And let's compare the difference between the employer. Now, if I went to work for an employer and both employers were going to offer me a base salary, and both employers were going to offer me a 401k with up to a 6% match, and so the only additional benefit that I might be getting offered is one of the left-hand side. So an employer is either going to give me a bonus, a deferred comp, a pension, an ESOP, a SERP, or something along those lines, but they're typically only going to choose one. And if I could have a comparison between just a bonus or an employer that would offer me the base salary, the 401k, and instead of a bonus, I could have a plan that would give me death benefit in the event that I die. Here's the 24% of people that die. But for all the rest of the people that happen to live, I can take that death benefit and I can use it in the event that I needed it for some type of illness or injury. In the case of National Life, if I'm using Allianz or Minnesota Life or one of those carriers, they don't have the critical injury, but they do have the chronic and terminal. So the point is that we've got living benefit coverage to cover the main concerns, which are the long-term care type benefits and terminal illness type benefits and needing access to that money while I'm still alive. Now, everything else that I put into that account, this benefit will also give me no limits on the contributions I can put into the plan. I'm going to get upside crediting on average 80% of the upside of an S&P or some type of index without any market loss. So I'm not going to suffer any down markets. I'm going to be able to grow the money in that account tax deferred, and I'm going to be able to withdraw the money from that account tax free. In addition to that, I'm also going to have access to additional money that I can contribute to my plan. So for every dollar I put in my plan, I will be able to use $3 additional. I only have to make contributions to this plan for 5 years and I'm done, and I get use of those $3 additional for the next 15 years. I get to borrow that money at a borrowing rate of LIBOR plus 1.75. Today, all in, that would be a little over 3. I have no financial underwriting, no personal guarantees, no credit checks. I'm merely assigning my policy as the sole collateral for this plan. Now, imagine you walked into a room and you had an employer that offered you this, base salary 401k and a bonus versus base salary 401k and all of this. Which plan would you choose? Every single person that I have talked to, when you lay it out like this, says hands down, this is the benefit plan that they would choose over anything else that's being offered to them. Now, how do we offer so much more without increasing the expenses significantly to the company? We're going to do what Peter Drucker talks about businesses doing today. Businesses are easily defined. It's other people's money. Why? Because business owners go out and they borrow money either from stockholders or from banks to grow their business. All we want to be able to do is use the same philosophy and use other people's money to pay for our employee benefits. So what exactly is leverage? Leverage is the ability to go out and purchase more today or buy more benefits today than I would be able to buy with my current dollar. Same thing works inside of a business. Same thing works with your house. People don't go out and buy a $500,000 house or $1 million house and pay cash for it today. They put 20% down and then they buy that $1 million house with $200,000 of their own money. They're still living in a $1 million house. They still have the benefit of that $1 million house, but it only costs $200,000 of their money because they used the bank's money. You can do the same thing with real estate investments. You can do the same thing with any of your big purchases, cars, media rooms, remodeling, anything that you can think out there, you can use leverage for. And in fact, most people do. What most people are familiar with these types of loans is in real estate. So if I'm a real estate investor and I've got $100,000 to invest of my money, I can take that $100,000 and I can go out and I can buy one house and I can wait for the market to go up and I can flip that house and I hope I make a profit on it. Or I can go to the bank and I can put $25,000 down and borrow $75,000. And now I can take that same $100,000 and buy 4 houses instead of 1. Now, I would say that my risk has been minimized here because if I have the ability to flip 4 houses, the likelihood that I'm going to make profits on 3 out of 4 of those is pretty high. If I buy 1 house with my own $100,000 and I don't make a profit on it, that's a lot of risk. So to me, leverage means that you're spreading your risk and giving you the ability to get so much more today than you would otherwise be able to get. Now, how does this work? Why would a bank loan you money to go out and buy investment properties? Well, for one thing, you're putting a down payment down. So you've got cash that you're putting into the house and you're covering the cost. Any theft insurance, fire insurance, flood insurance, renter's insurance, whatever you're using it for, any cost incurred on that house are being covered by you. If the roof blows off the house, you're going to put a new roof on the house, and you're going to pay the bank interest on that loan. So they're going to get a rate of return for allowing you to get that 30-year mortgage or that 15-year loan for that investment property. What does the bank get out of it? The bank has the house securing the loan plus the $25,000 you put down. So in a worst case scenario, if you default on the loan, they can go out and they can sell that asset and they can recoup their money. The bank is also going to be earning some kind of interest on that. And so they're making money on the money they're loaning you. And you're going to provide them with the personal guarantees so that if there's any shortfall in the sale of the house, that you'll cover that. So now how do we apply that to life insurance? We're going to use the exact same logic that we're using for the house. We're just going to switch it out for the cash inside of the life insurance policy. So don't think about the life insurance policy from a death benefit perspective. The bank does not care that you go out and buy $1 million and die 50 years from now. They are not interested in the death benefit of that life insurance policy at all whatsoever. All that they're interested in is the cash that's in the policy. So think about this. First off, what the bank is giving up instead of the house is they're going to be having their money invested in an investment grade bond portfolio. So for every dollar that I send to an insurance company, the insurance company is going to deposit that in an investment grade bond portfolio. It's not in the market, so it's not subject to market risk. If the market goes down by 100% next year, my money that's in my bond portfolio is not subject to any losses on that. And in fact, a lot of insurance companies buy principal protection where they will say, we guarantee a zero floor, meaning we guarantee no market losses. Now, what comes out of that policy is the charges. So when you put your $25,000 down, you're going to be covering the mortality charges and the fees and expenses associated with the cost of the insurance. If your employer is providing this for you, your employer's dollar going in is going to be covering the mortality charges, fees, and expenses of the insurance policy. And at some point when you get out of the loan, you're going to be repaying the lender. Now, the lender is going to be putting in the $75,000, and they're going to be putting it in the investment grade bond portfolio that is protected by the bond portfolio that the carrier has, not the individual client. The individual client is not providing the personal guarantee here. The insurance company is providing the guarantee on the bond portfolio. The bank's money is going into the bond portfolio. Your money's covering cost of insurance. I have an A or better rated insurance company that's been around for 100+ years, and that is a very safe loan as far as the bank is concerned, as long as you're covering the mortality charges, fees, and expenses. And then I'm going to exit the loan in the 15th year, so I'm not waiting for these clients to die 30 or 40 years from now to get repaid, and I'm going to get an interest on that loan. So this is a very, very safe loan. So how does it work? The first 5 years, equal contributions are going to be put in by the employer, employee, and the bank. Now, you'll see in this example that the leverage amount is a little bit higher, but that's because it's not an actual 50-50. It depends on your age and your health. So it's not exactly accurate, but it's close enough. It's almost a 50-50. At the end of the 5th year, you're done with the contributions, and now the bank is going to make double contributions. So they're going to put in from years 6 through 10 an additional $329,000. This is what gives you that 3-to-1 leverage, because now you have a total of $495,000 that the bank has contributed in addition to your $165,000. This is what's giving you that 3-to-1 leverage. You see, 1, 2, 3 to your 1. The policy is now the collateral. The bank has an assignment of this policy, not of you having some kind of personal guarantee. In fact, you're not even on the loan. The client only has to contribute 5 years, so it's very, very short. Whether you're an employer or whether you're an employee, everybody can do 5 years. And the borrowing rate that we have on this loan is LIBOR plus 1.75. Now, a lot of people that haven't been in the financing business probably don't know how inexpensive that is, but even a lot of our wealthy clients that are borrowing $500,000 or $700,000 instead of $30,000 aren't getting LIBOR plus 1.75 pricing. So we're going to contribute the bank's money and the client's money. That client is either the employer or the employee or a combination of the two. And we're going to put that into the index life policy. And we're going to make those contributions for a 10-year period. And then we're going to let it grow for another 5 years so that we get maximum growth out of this plan. And then we're going to loan exit. So we're going to borrow the money out of the policy or withdraw the money out of the policy that we borrowed from the bank, plus the interest. Now the bank has released the assignment on my policy, and I have any excess cash growth that I earned in that policy over and above my own money that I put into the plan, and it's mine free and clear, and I'm going to let that money grow until I decide to retire. Once I retire, then I can take my contributions. Now, let's look at what that means. Now, on the left-hand side, my employer gave me a bonus. So remember I said on the left-hand side, if your employer was going to give you a bonus plus your base salary plus your health insurance, on the right-hand side, the employer has given me the Kai-Zen plan. So on the left-hand side, I took my bonus and I put my bonus into this index policy, the exact same policy that I'm going to use for Kai-Zen, and I did it with my own money. If I put in $33,000 a year, that means I'm putting in roughly $165,000. I would be able to take out $33,000 a year at 65 to 90. That's going to give me a total income of $882,000, and that's going to give me a death benefit with living benefits of $499,000 left over at age 85. But if I apply the exact same assumptions to the exact same policy, and all I do is add the additional bank money, so now instead of contributing 165, my 165 plus the bank's money allows me to get growth on 660,000. What does that do for my benefits? That gives me $74,000 of income a year instead of 33. I'll be able to take out $1.9 million of income from 65 to 90, and I will have a death benefit and living benefits left over after age 90 of $845,000. So as you can see, this plan significantly beats the other plan, which is the identical policy. So a lot of people say to me, what happens if you don't get any growth and you've borrowed the bank money? Well, it's the same thing as what happened here. If you use your own money and you put your own money in the plan and you don't get growth, all you have coming out is cost of insurance. You still have the benefits. So here, I'm going to have more cost because I didn't get any growth. That's what happens. If I decide that I don't get growth every single year for the rest of my life, I have no money saved in my 401k or any other account because the entire market's gone to hell. I'm not getting any growth anywhere. If, however, I believe that over time the market will go up, like I'm selling you here, I don't sell you an index policy if I don't think the market's going to grow because you get no growth here. Here, the same thing, the same logic holds true. All I did was cram a lot more money into that policy so that I get a lot more growth in the early years. Now let's look at the numbers. Here's the $34,000 that I contributed. Actually, $33,000 is what's going into the policy. $1,500 of that is being escrowed for the trust fees. We'll talk about that in a minute. But basically, the bank is contributing 33, I'm putting in 33. So there's $65,000 going in over a 10-year period of time, but I'm having to contribute the first 5 years. What happens if I get out of the loan in year one? Okay, I put in $33,000. I pay off the lender, and I still have $24,000 left in the account even after I've paid the lender off with interest. If I decide in the 5th year I want to exit the loan and I pay off the lender, I still have $150,000 in my plan that's my money. So all we're doing when we're talking about this plan here is saying to a client, if you had the opportunity to get into an index universal life policy that would give you upside growth in the market without the market risk, the tax deferral, the tax-free income, the living benefits, the death benefits, if you had the ability to get into that plan, how much would you contribute? And then whatever that amount is, do you want to leverage that up and get the use of these additional dollars to significantly improve the accumulation feature and the death benefit? Now, what's even more interesting, because these plans are so quick to fund, I've already funded my 5 years. And so what's going to happen on my plan, I think I put this in the wrong place. This is actually my plan. So I have this out of place. I need to show you mine. Anyway, I'll go back and show you mine. This is in the wrong place. But basically, you can layer these, right? So if you start out and do one of these for a 5-year period of time, you can see that you could have generated a $74,000 income from 65 to 90. But if you were my age and you did this at 53 when you got in, or 54 when you got in, and you could layer it up and put another 33,000 in there, you can draw an additional 92,000 of income 70 to 90. So you can see that you can really get a much more significant benefit. This is layering it without the Kai-Zen money. This is layering it with the Kai-Zen money. Now, the reason this one is so much more is because I did a variation of the theme. The first one I did as a Kai-Zen, which is just like an executive bonus. So I got my money, I got my $50,000 bonus. I took that, I paid taxes on it, and I had 33,000 or so left over, and I put that in the Kai-Zen plan. In the second design, I got to do Tri-Zen. Tri-Zen allows me to do a loan from my employer instead of getting a bonus. I did this as a loan because I'm a C Corp, and so I could put in pre-tax dollars instead of after-tax dollars. So I'm able to put in 58,000, and now I can get that 58,000 leveraged up with another 60,000. And now I can take out 92,000 of income a year and still have $1.2 million of death benefit left over, which will give me this layering effect that I showed you here. Now, whether you're using Kai-Zen for both of these layering effects or whether you're using a combination doesn't make any difference. The point is this number is going to be significantly more than what you would be able to do on your own. So when you're talking to an employer about comparing benefits, and if that employer is doing nothing more than paying these executives a bonus, that bonus, they can take that bonus and they can contribute it to the Kai-Zen plan and they can pay a lot more money. Now, of the $33,000 that we were talking about, that employer can pay a portion, they can pay all of it, they can pay none of it. They can do one thing for one person and do something completely different for somebody else, so they can totally discriminate. Let me give an example. NIW did this plan for our employees, and when we did this plan for our employees, we did it based on the bonus dollar amount. So we take that bonus dollar amount, and let's just say that that bonus dollar amount was $15,000. So in my example, NIW gave me a bonus for $15,000 to contribute to my Kai-Zen plan, and I topped up the rest. So I put in an additional $18,000 to get to my $32,000, whatever it was, $33,000 total. So 15 of it was NIW, 15 of it was myself. Now, at the end of the 5th year, I'm done. But guess what happens? NIW keeps giving me the $15,000 bonus. And so in year 6, I'm getting reimbursed for the additional payments I had to put into the Kai-Zen plan. So You can set this up any way you want. What does that mean to me? That means the longer I stay at NIW, the more reimbursed money I get covering the additional contributions I put into my plan. Some employers might say, hey, she's so valuable as an employee, I'm going to do all of her $33,000 for the next 5 years, and then I don't have to do any more. Now, let's go back to a calculator for a second. If I did it the first way and I just decided I'm going to pay $15,000 a year as a bonus to Grace, it doesn't matter if I put it in Kai-Zen or not, and I'm 50 when I start that, and I'm going to pay that to 65, that means I'm paying $15,000 for the next 15 years. That's $225,000 that I'm going to be paying as a bonus. If I did the whole contribution for the next 5 years, I put in $160,000 for a 5-year period of time, saving my firm $65,000. Even though I put it in over a 5-year period of time, I could draw down on my line of credit to pay that because cost of borrowing is so cheap and save the firm $65,000. I could add a golden handcuff that says I only vest $15,000 a year and tie myself to this, or tie my employee to this plan. And I'm just throwing out and brainstorming ideas with you guys just to tell you all the different variations of the way that you can use this plan. Now, one of the main things that we hear is this sounds too good to be true, and I'm not going to get into this whole presentation. I am going to tell you that there's no reason for people to believe this is too good to be true. We've been doing these types of loans for wealthy clients since 2000. We've facilitated over $4.7 billion of these types of loans. The only reason they weren't available to executives was because the cost of borrowing was too high. Let me give you an analogy. If I go over to TD Ameritrade and I open up a brokerage account and I deposit money in that account to buy stock, I'm going to buy some Ford and some Apple and some whatever else. If I decide that I want to get a margin loan, I want TD Ameritrade to give me a loan so that I can invest more money or buy more stocks than what I have money to buy, they're going to charge me 7% to borrow that money. That means that I have to earn a 7% rate of return before I can even justify why I'm borrowing that money. Anything over a 7% rate of return, I get to keep. That doesn't sound very appealing. However, if I put my same money in Warren Buffett Berkshire Hathaway fund, and I put that same dollar in there, and Warren Buffett went to the bank and he did a margin loan, he's going to get it at 50 basis points. So it's much more cost effective for him to do his billion-dollar portfolio than it is for me to do a $50,000 margin loan. So if you apply that same mentality, when we've been doing these for wealthy clients, they were borrowing on average up to $2 million a year for 10 years. That's a $20 million loan. I'm going to get much better pricing than I am if I want to borrow $30,000 a year for 5 years or $50,000 a year, whatever the amount is. The point is that the scale is much smaller, and the bank has to do the exact same amount of work and effort to monitor that $30,000 loan as they do to monitor that $2 million loan. And so which one do you think the bank's going to give good pricing to? So if you think about it logically, all we're doing is taking our same exact high net worth plan and we're borrowing $2 million at a time. I'm going to take that $2 million and I'm going to divide it into 100 different policies or 50 different policies or whatever. But the bank is not worried about the $50,000 on each person's policy. They're only worried about the $2 million loan. There's only two features of this plan that create skepticism or why clients or employers think this is too good to be true, and that is the feature that happens to be inside the index policy, upside credit without market loss. The reason that there's so much confusion around that is because most of you go out and we use the insurance industry's technology or name, which is an indexed life insurance policy. That was probably the worst name we could have given this universal life policy, because when you say index to a client, they're thinking indexed fund. If I went out and I bought an indexed fund, it is invested in the market. I have market risk. So when you say to your client that you're putting him in an indexed universal life policy, the first thing his brain says is market risk. So they do not understand how you can have the cash inside of an index type fund, because that's what they're thinking, and not suffer any market losses. So the first thing that you've got to do is you've got to go in and explain how index policies work and how the cash is actually going into a bond portfolio that is principally protected by the insurance company, and therefore you have no market risk. The second feature of this plan that creates skepticism is on the loan side. Nobody has ever heard of being able to borrow from a lender and not have to sign loan documents or apply for credit or have personal guarantees. So if I walked into a bank and I said to a banker, I'd like to buy a house, I'm going to put 25% down on the house, and then I'm not going to make any more payments. I'm not making interest payments. I'm not making principal payments until the 15th year, and then I'll pay you off. I'm not going to allow you to do credit checks on me. I'm not going to sign any documentation. I'm not going to do any financial underwriting whatsoever, and no credit checks. How much money are you going to give me? They would look at you like you're insane. Yet that's the very type of loan that we've set up. And the reason we were able to set it up like that is because we are housing a master trust, and because NIW has facilitated these types of loans since 2000, and since we are 5% plus or minus where we illustrated we were going to be, and since none of our banks have lost any money on these $4.7 billion worth of loans, they said as long as you're using the same type of loan structure, stress testing, administration that you're doing on your high net worth, we will be willing to allow you to borrow this money in a lump sum amount and disperse it into these policies, and the master trust will be the loan obligator. Because the master trust is the person that is negotiating the loan, I don't need individual underwriting for each individual client. Therefore, the employer is not on the hook for the loan. They're not signing any loan documents. The employee is not on the hook for the loan. They are not signing any loan documents. So I'm skipping all this part about the product. You can use this if you want when you're talking to somebody to explain how the index products work. I'm skipping that today just because of time. And I'm going to try to go quickly to the trust and show you the leveraging part. Okay, so the first thing that we do is we have each individual participant get their bonus. When they get their bonus, they are going to set up a trust, and they're going to fund the trust. Now, imagine this is NIW, and imagine each employee that's participating has set up their own trust. That's a money market account. The trust, mine is called the Grace Barnard Trust. I put my bonus into the trust. I've named my beneficiary, whoever I wanted to name, and then I waited for my colleagues to sign up. Once they were all signed up and had all funded their trust, we did not fund the policy yet. We have a trustee that is Provident Trust. They're a third-party trustee, and we are collecting or escrowing 5 years of $1,500 fees to pay for those trustee fees for the next 15 years so that they will monitor these trusts. Once we have that set up, we now are ready to go to the lender. We set up a master trust. This is a completely separate trust. It's not party to my trust or any of the other people's trust. That master trust is going to go to the bank, and they're going to say to the bank, I would like to borrow $2 million, please. Under these terms and conditions, I would like LIBOR plus 1.75 pricing. The bank says, where's your collateral for that loan? And I say, the $2 million is in each one of these accounts, and all you need to do is go in and add up all of those accounts, and those accounts will equal the $2 million. The bank goes in, they do their due diligence, they look at the account value of each one of those money market accounts, and then they sweep those accounts for the $2 million that were in the combined all of the people's trusts, and they add the $2 million from the bank, and they send $4 million to the insurance company. The insurance company will now issue those policies back to each individual person's trust, and the trustee will assign those policies back to the bank until the loan is paid. Let's assume we're at the end of year one, and I decided that I lost my job and I don't have the money to fund this on my own, and I need to get out. They will unplug my design, my assignment will be released, my payment will be made back to the bank of $33,000 plus the interest, and now my other $33,000 minus my cost of insurance is still inside my policy, and I still have my policy. I can take it with me wherever I want to go. I still have my trust, and my policy is still inside my trust. I can decide to stay with Provident Trust, to manage that trust, or I can decide to have a co-trustee or somebody else manage it, or I can decide to dissolve the trust. Whatever I want to do, I'm out of the plan, and now next year when I go to the bank, I'm going to borrow $1,970,000 or whatever that amount is instead of $2 million. Make sense? So as you can see, we can easily unplug anybody at any time that they want to get out of the plan. However, if you're out selling this to a group, you don't want to sell it that way, because the reality is, if you only have to contribute for 5 years, you don't want this plan to go away at all. And in fact, when I got my third payment into the plan, I was like, oh my God, I'm almost done. I was more excited about being done than I was about my rates of return. So just for those of you that are curious, let me show you my actual rates of return. I like to use my own numbers, and the reason I like to use my own numbers is because my own numbers are so much more compelling. So let me just show you guys what we've been able to do with these types of designs since 2006. This happens to be a group plan. There was 35 people in this particular company, and we started this plan in 2005, and at the end of 2006 we started to credit. Now, the reason I wanted to show you this one is because this one is actually with Allianz. There's over $100 million inside this plan. And they had 3 different funding time periods. So they allowed people to get in March, in May, and in November. But what I wanted to show you about this is you can't time the market. You have no idea whether you should get in January versus May, whether that makes any difference. So the point I was trying to show here is it doesn't matter. What we're really looking at is the actual spread. So if you look at each one of these credits, the March credits are 7.52, 0, 0, 19, 5, 1, 5, 12, et cetera, et cetera, et cetera. In this particular period of time, you have 1, 2, 3, 4, 5, 6, 7, 8 positive credits and 1, 2, 3 negative credits. In any 15-year time period or any 20-year time period, you're going to see at least 4 market corrections with at least 4 zeros. On the next one below, you're going to see 7 credits, 4 zeros. Sorry, not 7. 1, 2, 3, 4, 5 credits, 4 zeros. Here, you see 2 zeros and 8 credits. So the point I'm trying to make is it doesn't matter. They're all over the place. And what is the bank loan is really what we're interested in. So if you look at this box that's blown up, it shows you the March group. The average interest rate on that group was 6.56. In other words, if I took all of the credits and added them up and divided them by the number of years they've been in the plan, that gives me an average credit of 6.56. But who cares? Because if it was my own money, I'd get that, and that's fantastic. But what about the money I borrowed from the bank? That's the additional money I put into the plan. On that money, I had a borrowing rate on average of 3.45. And that means that I have a spread of 3.1. I'm modeling for somewhere between 1.5% to 2%, depending on how old you are, to make these designs work. My May group had an average credit of 6.1 with the average borrowing rate of 3.4 with an average spread of 2.72. And this one has an average of 5.5 with a same bank average 2% spread. Again, what I'm looking for to make these designs work is an average 2% spread. Now let's look at mine. This is my actual statement. These are my actual credits. And as you can see on my actual credits, from 2013 to 14, I had a 13% credit with a 2.75% borrowing cost. From 14 to 15, I had a 7.5 credit with a 2.75 borrowing cost. 15 to 16, I got 0 with the 2.75, and 16 to 17, I got 12 with the 3.07. My new borrowing cost going forward is 3.47. I don't know what I'm going to earn until the end of the year. At the end of the year, I will have whatever that credit is. Now, if you take that 4-year average, that gives you a 4-year average return of 8.13 with an average loan rate of 2.83 and an average spread of 5.3. Now, guess what, guys? The policy that you sold your clients, they're getting the 8.13 credit. That's the amount of money when you went out and you sold them an index policy that they said they can put in. So when I sold myself the policy, I said I could contribute $30,000 a year, and I got that whole 8.13 minus cost of insurance of that money. But I also have an average spread of 5.3 on the rest of that money that I borrowed. So all that additional money that's going into this plan, I'm getting a pretty good rate of return. Now, I don't anticipate this spread to hold true. And as a matter of fact, if you go back and you look at historical spreads, let me show you some historical spreads. The historical spreads on borrowing money are around 2 to 3. We have not been able to find a 15-year time period where at least a 2% spread doesn't hold true. Hence the reason we're borrowing the money for 15 years. It doesn't matter what time frame you use. If you did a loan like this and you borrowed money from 1930 and then paid it off in 1945, your average spread on that loan is 3.3. So if I borrowed money in 1930 and I had this type of product, according to the actuaries, I would have had about a 3.3% spread. If I borrowed it in, a 3.9% spread. It's actually 3.3. I don't know what happened to that screen. I need to fix it. If I borrowed it in the 1980s, where interest rates went up to 18%, I still had a 3.2% spread. If I borrowed it from 1930 all the way to the end of, or the beginning of 2015, I have a 3% spread. 6.35 was my averaging borrowing rate, 9.3 was my average credit. If I borrowed it from 2000 to 2015, I have a spread of about 2.4%. Here's my average loan pricing, 4.2. Here's my average IUL, 6.63. We've done these rolling averages for 15 years, 1930 to 1945, 1931 to 46, 1932 to 47, and so on and so on and so on. And we have not been able to find in any one of those 15-year time periods less than a 2% spread. Now, that wouldn't be true, obviously, if I got in year one and I had 3 years of zeros and I got out, I'm taking a loss. So you do need to hold these on average for 15 years. If I did a 5-year rolling average and said, what is the likelihood that I'm going to outperform my loan over 5 years, it's a flip of the coin. It's 50-50. I could get in the 5 best performing years of the market, or I could get in at the 5 worst performing years of the market. So it is almost 50-50. If I hold on to it for 10 years, that number goes up to 90. It's in the low 90s, high 80s, low 90s. But if I hold on to it for 15 years, that likelihood that that spread is going to hold true is 99.999, whatever the numbers are. But anyway, it's almost 100%. So the point is that your clients want to get into this design and they want to use this for retirement. And if I'm talking about an employer that's offering benefits, I'm talking about a long-term benefit that gives them so much more than they would be able to obtain on their own. And I'm only having to contribute 5 payments to it, and I can design it around any way that I want to design it for my firm. And it gives me so much more flexibility and so much better benefits than anything that's out on the market today. And do you think this sets you aside compared to all of your other colleagues in the business? You bet. If this is my benefits package, I'm going to have a tough time. Not having retention problems, because who wants to walk away from all of this? Versus if I get a phone call from a headhunter who says, hey, I know a company that's offering you $5,000 more. Well, $5,000 more doesn't mean a lot when we're talking about how much more I can accumulate for retirement, taking that same bonus money and leveraging it up. So that's the end of the presentation today, guys. For those of you who want to drop off, have a fantastic weekend. I hope that you enjoyed the presentation. I taped it, and so I'm going to be putting that up on the website. So you go to kaizenplan.com, and you'll be able to listen to it off of the YouTube link. For those of you that want to stay on for questions, you need to raise your hand. If you've written me the question, I can't read the written questions while I'm doing the presentation because I have to go pull up the actual written questions and read them. So it would be easier for me if you'd raise your hands if you do not have the ability to punch in the PIN number. So you dialed in, then you put in an access code. Underneath the access code was a PIN number. That PIN number will allow me to unmute you and ask your question. So, Dave?
Yes, can you hear me?
I can hear you fine, thank you.
Great. I had a few questions. Can an employee put more in during or after the 5 years than the structured amount?
No, because you're going right below the MEC limit. So let me show you. Now they can later. So what I'm doing with mine, remember I said I'm layering mine. So what I'm doing with my particular plan is I put in my 5 years, right? And at the end of 5 years, I can't contribute anymore because the bank is contributing that maximum amount. So I started my second one. So I'm doing a second one, and that second one is getting the same leverage as my first one. And so I can layer that. At the end of the 10th year, I've finished funding my second one. I can come back to this one because I'm in year 10 of this one, and I can start funding this one again. Make sense?
Yes.
So that's why I was talking about the layering effect here.
You can put more in.
Yeah.
Not during,
so
but
here's
after.
Correct. So here's what I'm doing on this one. I'm taking See how it's maxed out? I cannot contribute any more to this policy or I'll mech it.
Yep.
So I put in my 34, and I'm right now here with my second policy. So I started a new one, and I'm going to do these 5 payments here on my second one. That means I'm done on this first one. So now I can start funding this first one again if I want.
Sure. Okay. Also, what is the maximum age of a person that this would make sense for?
For income, probably 55. Because if you think about it, you're 15 years before you're getting out of the loan.
Yeah.
So you're 70, right?
Yes.
So maybe up to 60, but really after that, what you're trying to use it for is you're trying to use it to minimize your expenses. So think about it this way. If I know I'm getting ready to go into retirement and I want the long-term care features and the death benefit protection of this plan, I don't want to have to go out and buy those on my own at my retirement age. I would rather put in a much smaller amount and get those benefits paid for at whatever that cost is, but a fraction of what it would cost me to go out and buy a permanent policy plus long-term care and whatever other features that I have on my own. So a lot of people will use this to cover those medical costs that they're concerned about. Remember that $240,000 they're concerned about? A lot of people will use them to try to cover some of those costs and then use their other cash that they've been saving in their retirement account to draw down so that they don't worry about depleting that account to cover medical costs.
Sure. And speaking of medical, is a medical exam still required of the participant?
No, because this is not medical insurance. Well, I'm sorry. You have to go through financial underwriting to justify the death benefit. But the living benefit feature of this plan is nothing more than the death benefit. All you're doing is saying to the company, I paid you for a flat amount of death benefit. And in this example, let's just say I've got $843,000 of death benefit at 65. And I want to use that death benefit today for living benefit. So let's say I needed it for long-term care. I can take out up to $30,000 a month or 1% of my death benefit monthly. And then it's capped out. So the amount you can accelerate is capped out at 1.5, I think. It might be 1. You'll have to look at the chronic illness features. So that means I could pull out $30,000 a month for long-term care until I hit that $1 million cap or $1.5 million cap, whatever the number is. I think it might be $1 million. So you have to look at the features of each plan, each policy.
Okay, but I mean, for underwriting, do they still have to have a medical qualification?
Yeah. They're still going to have to have. They're still going to have some kind of blood work and medicals that the doctors, that the insurance company is going to order. So yeah, they've got to qualify.
Thank you.
You're welcome. Have a good weekend. Okay. Let me go see if there's other people that have their hands raised. I'm not sure if Maguy, is that how you say it? It's M-A-G-U-Y? Maggie, sorry.
Yes, I'd like to know if there's a minimum and maximum age to use the Kai-Zen plan. And
the minimum is 1.5 million unless you've got a big group. So let me explain that. When you go to the Kai-Zen website, you're going to be able to pull up these illustrations and you'll see the minimum. So if you've got a client that is individually participating in this plan, that you can go onto the website and you can look up the carrier. So whether it's National Life, whether it's Allianz, whether it's Minnesota Life, whoever the carrier is, that's where these are. So whatever carrier you're using, you go into their illustration software, and then you go into the sample illustrations. Now, this is what I do. I basically, when I'm sitting down talking to an individual business owner who says, can I use this for me? And individually, I say, yes, if you had this plan, how much would you contribute? They tell me a dollar amount. Let's just say you can give me a dollar amount. 50,000, is that a good dollar amount? Whatever the dollar amount is, let's just say it's $50,000, and the person I'm talking to is 51 years old, and she happens to be female, standard health. I'm going to go in and I'm going to pull up the 51-year-old. I'm going to open that up, and I'm going to be able to go scroll down and say your minimum contribution for 51-year-old is $34,000, $35,500. Okay, so on the illustration that you're pulling up, you have these numbers here. So the first thing I said is you meet the qualifications for the minimum. If you want to put in 50,000, then we can go look up a different age. We can look up the 2 million. So you scroll down to the 2 million. We looked at a 51-year-old, and you can pull that up and you can see what the contribution is for 2 million. And you can figure out that the 2 million is 45. So it's 46.5. So this is close enough to the 50,000 to show them what an example looks like. So you can say, if you put in almost $50,000, you're going to have an income stream from 65 to 90 of about $59,000, and after you and still have a death benefit of $869,000. So it gives you a rough estimate. You know, if somebody says, well, what if I put in 100, then double these numbers? So you don't need, I mean, the whole purpose of this is not to get into the specifics of the samples or illustrations or what they're going to get. The whole purpose of this is you tell me how much you can afford, and I'll tell you if you qualify for the minimum, and then I can get close to the contribution amount that you want to put in. If they told me that they wanted to put in 60,000, I'll go back to the 1.5 and double that one up. So you can use these samples and figure it out without running 50 million illustrations. I don't sell off of illustrations at all. I basically just say to the client, what difference does it make if you put in an extra 5,000 here from what I have illustrated? That's just going to bump up this income to, let's say, 65. It doesn't have to be that specific. The most specific thing is that can they or can the employer handle the initial contribution? So these are the minimums. You got your minimums at 1.5, and then you can use the 2 and the 1.5 to double them up. Now, if you're a company that has 2,000 employees or 500 employees, I don't have to stick to these minimums. What I'm looking for is I'm looking for the group pricing on the loan. I need to have at least $2 million of total contributions of the group in order to get that loan pricing. So if I want that to be $10,000 for 100 people or 200 people, that's fine. If I want it to be $1 million a piece for 2 people or 2 partners, that's fine too. I just need to be able to go borrow at least $2 million from the lender to get my 1.75 pricing. So if you're doing your own individual group and you're going to be doing your own funding plan, as soon as you're done funding that group or enrolling that group, you're done and we're funding it. If you're selling to individual people, then you're going to have to put them in the tranches, and you're going to have to go look here for those dates. So here's the tranche deadlines. So you click on the tranche deadlines, and it'll tell you what those dates are. The next tranche deadline is August 31st. So for all your clients that want to get into this plan individually, they have to have done their paperwork, set up their trust, and funded their trust before August 31st to be able to be in the next group that we're funding. That's when we'll pool all those people together that are individual partners from across the United States, and we'll put them in one tranche. So it doesn't really make any difference whether you're part of a lot of people across the country or whether you're part of your own company, because you don't know the other people that are participating anyway. You know, if I walk down the hall at NIW, I don't know how many people are in the plan and how many people are not in the plan, right? So it doesn't really make any difference whether I'm in this group with 500 other business owners or whether I'm in the group with NIW. But the reason that we do these tranches is because a lot of people are calling on small businesses, guys that have 4 or 5 people in their company, and they don't have enough to do their own loan, and so we can piggyback them with lots of other people that have five-man companies. If you're doing your own company, that gives you a little bit more control, because then you can say to the company, we've got an open enrollment date of such and such, and when we collect all the paperwork, then we're going to fund. But all of that information is here, accessible to you. All you have to do is go into the website. It's got paperwork. It's got just about everything that you'll need. You just need to have access to the website and be able to log in. And once you log in, it'll give you access to all of the marketing materials, all of the enrollment forms, everything that you need. Marketing materials are here for each company. So here's brochures that you can customize, flyers, check sheets. Here's the PowerPoints. And these are the ones that are compliance approved. If you see me do a different presentation on Friday, it will not be on here to be downloaded because it is not compliance approved. Every single time you change one picture, one statement, you've got to send it back through compliance. It's a nightmare. So what we do is we make the ones that are compliance approved available for you to download. And if you want to watch one of the ones on the weekly webinars, we post them each week. So you just have to go and look for the one for last week, and you can click on it. When you click on that, it will allow you to speed it up, slow it down, whatever you need to do. So you can go through the slides until you find the part of the presentation that you want to listen to, and then you can go click and it'll start there. Okay, so we try to make it as accessible as we can, but we can't send you out the actual PowerPoints because until we send them through resend them through compliance, it's just too time consuming for us to try to get each one of those approved. So let me find out who has additional questions. Matthew Papa, I have no controls for you. I don't know what you did. You must have joined. You must have joined with the computer because you have no phone for me to unmute you to ask your question. So you must be doing this from your computer. I apologize. You'll have to just call me separate. Brian? Zeke?
That's me. A question on the, I like the layering idea a lot. That's another idea, because in terms of a continuous bonus and the golden handcuffs, could an employer potentially continue the bonus and pay the loan down as a bonus?
Well, in essence, you're doing that, because if you keep, like in my example, NIW pays a bonus each year. But let's say my bonus was 15. On my plan, I put in 32.5, right? So at the end of the 5th year, let's say I'm done. Forget the fact that I layered it. But at the end, let's just say I just did 1. In year 6, I'm getting 15,000. I get to take that back now. That helps me contribute and pay for my plan of the 32 year 1, because I'm getting reimbursed. So the longer I stay there, the more of that reimbursement I get back. Now, if my employer paid the whole thing, the whole 32, and in year 6 I was getting another 32, I would be layering it and doing my second plan. Although I am doing my second plan also, because I don't necessarily need to get my money back as much as I want to get more money into this I want to get more leveraged dollars.
Yeah, and that's something I was sort of curious about anyway, because because obviously if you take all the money out of you pay the loan back out of the policy, you're obviously impacting the policy. And I was just looking in terms of if you were reduced the amount that was borrowed against to pay the loan off later on, it would create more income. And that's sort of the angle I was looking at.
You know, if you've got a lot of clients that have captive assets, this may be a way for them to take those captive assets. You know, at some point you're going to dissolve the captive. So maybe when you retire and you don't need the captive anymore, you might dissolve the captive, pay your long-term capital gains, and then use those assets to pay off the bank loan. That way I don't have to take the cash out of the policy. I can leave it in there in a tax-deferred, very efficient vehicle. That would bump up my growth here, or my income here.
Exactly. That's sort of what I was looking at, is how that would impact that, having an outside. Now, that's what I was looking at. If the employer continued to pay a bonus but paid it into, I don't know if you can prepay the loan or not, start paying the loan down.
No, but you can put it in your trust, so you can fund your trust,
okay.
and then you can balloon it.
Oh, gotcha. Okay, so you could actually continue to fund the trust, and then the trust will eventually pay the loan. Am I
now,
that?
also, yes, that's correct. Now, also think about it from the standpoint of people that have like brokerage accounts. So I have an investment portfolio. It would make a lot more sense for me to take those invested assets to pay off this loan, to keep the cash in this policy, getting me that growth. So it doesn't have to be captive dollars. I was just throwing ideas out. It could be a
that's
It could be a brokerage account. You just want to keep, you know, any of the accounts that you're getting the tax advantages on. Those are the ones that you want to keep the longest.
Right. I do like the layering idea a lot. That's to continue to pay a bonus, and I think that would be pretty effective as well, because it would just help everything.
Once you really figure this out, the advantage that you have with the leveraging piece, once you really get that in your head, the variations of the themes, the things that you can do are so exciting. They're just really, really exciting. And this is really the reason why we started out with Kai-Zen, because we hadn't even thought of Tri-Zen. So we're a C Corp, right? So all I did was get my $50,000 bonus, and then, or it wasn't that much, but if it was a $50,000 bonus, I would have had 30-something thousand left over, and that's what I contributed to my initial Kai-Zen plan. So that was going to give me a good income, but then I figured out, oh crap, if I'd done this as a corporate split dollar and borrowed it, I can put in 58,000 instead of 32,000, and I can get a lot more income and a lot more death benefit, even after paying off the bank and taking into account the amount of death benefit I need to pay off my employer. Because remember, I'm not paying my employer back with cash. I'm paying my employer back with death benefit.
Exactly.
So I'm buying a much bigger policy. So I'm still getting more death benefit, even after loan payment, than I am if I was doing this on my own.
Yeah, well, that's a beautiful thing about using the IUL with the death benefit and everything you have. It sort of protects everybody at the same time, including the employer. So. Right.
And there's just so many things that you can do with this. From, you know, I even had a conversation with a company the other day where they're talking about their buy-sell agreement. And I said, why don't you, as the company, just put in the amount that you were going to do for death benefit to buy that amount, and then allow each one of those partners to top that up for additional contributions. You have an assignment over the death benefit to get for the money that you put in. So whatever additional money you put in that the company paid for, the company becomes part of the beneficiary for just that part of the death benefit. That takes care of your buy-sell, but the reality is what it really does is it gives each of you a retirement account to take with you.
It's a beautiful thing.
It's really, really exciting when you start. Yeah, it's very, very multi-purpose, and you just have to be creative and conceptually think and listen to what they're saying to you, what need it is they're trying to accomplish, because a lot of employers go, I just want the term cost equivalent. Well, this plan, you are getting the term cost equivalent, and here's why. The money that we're putting into this plan, we're shrinking the cost down of this plan so that we're putting the minimum death benefit for the maximum contribution. And then we're doing spread comp. And so this thing from a fees and expenses standpoint is very, very inexpensive. And if I showed you that, I don't know if I have it on here, the comparison to the term cost equivalent, I did a term cost platform. Here's what the problem is with executives. It sounds great to buy term insurance to age 65, right? Because it's cheap.
Right.
But it's when it goes past age 65 that it starts to escalate very significantly. And the problem with a lot of these law firms with these big executives is lawyers don't quit at 65. They might be there till 70 or 75 or 80, or they may be gone at 65. You just don't know. So the problem the company faces is at 65, if they're still there, now they got to buy another term equivalent policy. So I did one for a law firm. Oh, it was huge. I did one of these, and this is exact same model to this. I did it on a 45-year-old attorney, and I did it to age 90 because they had some of their partners in there that were in their 80s that were still working there and still taking an income. And so I did the term cost equivalent, and I did a 45, 30-year term to 75, and then I did another 20-year term, whatever it was, and then I just added up all those costs to age 90, which was life expectancy, and it was $670-something thousand. I could accomplish the same thing here with Kai-Zen for $165,000.
And that's something.
And so what I'm saying to these guys is, look, if you're getting the term cost equivalent in here, let the company pay for the term cost equivalent, but give the employees the benefit to be able to put in more money over and above, assign the $1,500,000 to $200,000, whatever it was you were trying to buy from a buy, sell, or key man to replace them, and let them take that benefit with them after so many years of service.
Oh, exactly. Because the term, you're left with absolutely nothing.
Right.
At the end of the day.
And one guy said to me, yeah, but I only have to put in like $3,000 a year for the next 30 years. You're making me put in $150,000 over 5. And I said, draw it down on your line of credit. Money's cheap right now. Draw it down on your line of credit. Pay the term cost equivalent each year back on that line of credit, and it's still going to save you money, even with the interest that you paid.
Leverage is a beautiful thing.
Right. So you just need to be able to listen to what they're saying and then come up with a creative solution for what it is they're trying to accomplish more cost effectively than you know, they're only looking at the 1-year premium on Kai-Zen of $30,000 going, I was only going to buy $3,000 of term. So you got to lay it out, and you got to run the illustrations out to what they're using it for. If you're telling me you need it until this guy retires, and that's why you want to buy term because it's cheaper, run it out, get them to tell you how old this guy's going to be when he retires, and then just do a side-by-side cost comparison and show them how much more they're going to get.
They're going to get for their money, absolutely. So, beautiful.
Right. Thank you. Have a great weekend. Okay, let's go see if there's other people that have questions real quick. Matthew, I still see your hand raised. I apologize, but you clicked in on something, computer or something. I just can't. I don't have the ability. Oh, wait, maybe I do now. There you go. Matthew, what's your question?
Hi there. Oh,
hi.
I'm sorry. I used the code in the beginning, but I backed out completely, and it gave me a different code, so now we're on. Okay. Okay, my question is regarding the suggested vesting schedule that you gave as an example earlier. On what are the does that, if you put a vesting schedule on either a Kai-Zen or a Tri-Zen design, doesn't that entangle the plan with 409A, and what are the tax and accounting issues that go along with applying a vesting schedule?
A vesting schedule is nothing more. First off, this has nothing to do with any type of qualified benefits This is when you're doing it as Kai-Zen, this is an after-tax dollar. This is a bonus
you're still saying
dollar.
Yeah, so it's a 162A bonus for tax treatment.
Right. Now, let me tell you, if my bonus amount, if I designated my bonus amount to you this year was going to be $15,000, but the actual contribution for Kai-Zen is $32,000. I'm going to have an agreement with you that I put in the additional $17,000, whatever that number is, right? Right. So I put in the additional $17,000, and I have a written employment agreement with you that says if you leave, you have to repay me any unvested portion. So now you've got to pay off the lender, and then you've got to take another $17,000 out of the policy and pay me back because you only vested $15,000.
Okay, so that's based on the loan agreement, not the plan.
Correct.
Between the employer and the employee.
Correct. So if I, as the employer, want to advance you that additional money, I can advance you the additional money, but you have to give it back. So you know how you do a house and sometimes you have second mortgage holder? The first mortgage holder has the assignment. When he's paid off, the second mortgage holder that can then take any remaining balance. That's in essence what the employer is doing here. They're basically going to be in the second loan position.
Yeah, I understand. That's a beautiful way to circumvent the entanglements of 409A and qualified benefit plans. Secondly, the slide that you showed, which employer would you choose? Is that a compliant slide that I could download?
It is a compliant slide if you add the disclaimers to it, and I could not get all the disclaimers on that page for you guys to be able to see it. What I can do is I can go back and I can add, the print would just be way too small. So where is that slide?
Can you do it on a page too?
I originally had it on two different pages. You guys have seen it before. It was with a guy that's kind of leaning back in his chair, and it's got like a third of the page is disclaimers. Okay. So if you're going to use this page, I would print it on like an 8.5. What is the longer sheets? The 11 by 17, whatever those longer.
Yeah, 11.
Right.
8.5 by 11 and.
I would print it on that, and then take those disclaimer pages on a separate slide and add those together.
Okay, so this slide that you've got up on the screen right now, is that in a PowerPoint that I could print it, or is it in the video that you?
No, this is brand new. I just took the wording. Okay. I just took the wording from the one that's on the compliant approved. And I took off the disclaimers so you guys could see it. But if you hand it to the client, you've got to hand it to the client with the disclaimers and with the wording that says upside crediting, and then it's got some little disclaimer next to it.
And that's on a current PowerPoint that I can use?
Yeah.
Okay, well, I don't have any problem with compliance, but I like, even just for my own benefit, in getting my feet firmly in this conversation so I can go in any direction like you can right now. I want to study this page as you have it up on the screen right now for my own edification. I can talk around it and I can give them compliant information, but I want it for my own practice. So
I get it. If I'm doing a presentation, Matthew, I could draw this on a chalkboard.
Yeah, that's where I need to be.
I could say to a client, if I gave you the ability to put your money in a plan that would give you death benefit and whatever the living benefits are of the carrier you're talking about, accumulation, growth, tax advantages, and leverage, how much would you contribute? Every single person I've ever shown that little box to has said as much as I could get my hands on. And of course you would. And the reason I want to do this in a company presentation is, think about it this way. If I sat down with you on an individual basis and I'm your insurance agent or financial advisor, and I said to you, how much would you put into a plan that looked like this? The first thing that they think of is that's too good to be true. But if I came to you and I said to you, here's the plan your employer is offering to you. Your employer has contributed the first $10,000. How much do you want to increase? The conversation completely changes. It's no longer too good to be true. This is the most phenomenal benefit plan I've ever seen, and I want to put more money in. They're assuming that the employer's already done all the due diligence for them and that this is their benefits package, and now all we're talking about is the amount of dollars.
Right. So this slide on the screen right now is incorporated in one of the PowerPoints I can download.
Yeah, and as a matter of fact, we're trying right now, we're doing a video where we're trying to get this in a video format that you can send visually to your clients.
Right. Okay, great. And then my last question is regarding major banks. If what I'm interested in, and maybe you know this and maybe you don't, what is the average spread that a bank earns on loans to an average customer? Like in our case, it's LIBOR plus 175. But if you were an average customer on the street and you went to Citibank or Wells or Bank of America and you did a loan for an automobile or a
you can't really compare it to an automobile. Yeah, I wouldn't compare it to those. I'd compare it to this. I'd compare it to this kind of financing, Matthew, because I just had a client yesterday who wants to do a $100,000 loan, and a premium financing person went to them and said, yes, we can do this type of premium financing loan, and you can borrow $100,000 for the next 5 years or 10 years or whatever it was, and I'm going to use the policy as collateral. The difference was they had to go through financial underwriting, they had to go through credit checks, and the price that the bank was quoting them on the spread was 3.25.
Okay,
that's 3.25 above LIBOR. Now, I've seen some, if you move up into the $500,000 range, where they might go to 2.25 or 2.5. But until you get above, until you get close to $1 million, you're not going to get pricing below 2% spread.
Right. Well, I mean, the genesis for the question, Grace, was if you look at Kai-Zen as a be your own bank concept, then so your bank is getting the federal funds rate, right? The bank borrowing rate at 1.75. If you were out there a customer in the big wide world, and Wells Fargo was loaning you, 25 or 50 or even $100,000, what would the spread that they make on their money be for you, the average consumer? That was my question.
Right. It's gonna be above 2% for sure. And the other part about it is you're gonna have to go through full financial underwriting, credit checks, loan docs, pledged collaterals, and pledged guarantees. And you're probably gonna have to pay interest on the loan on an annual basis.
Oh, no doubt about that. No, I don't think they would make you a loan for a $200,000 home improvement if you weren't paying interest and principal on a, say,
now,
a 10-year basis.
If I'm sitting in a meeting and I am competing with some other person that's doing a premium financing loan, and they're saying, come fill out the financial underwriting, the credit checks, all the paperwork, sign the personal guarantees, service it, 2% better spread, et cetera, who's going to get the deal?
Yeah, I agree. Okay, well, that does it for me.
Fantastic. Have a great weekend.
Thank you.
Okay, guys, is there anybody else before we hang up today that has a question? You need to raise your hand. I know that there's a lot of written questions on here. I apologize. I cannot read your written questions at the same time I'm talking. So if you quickly have any additional questions, now's your chance. I do not see anybody else. So if you had a question I did not get to you, you can call me. Get ready to write the number down. The phone number for NIW is 1-800-294-9940. That's 1-800-294-9940. I think it's on here. And you can call me and ask your question individually. I will try to go back and read the questions if there's something in there that I see that you can't get answered on the Q&A or the question and answers from the website. I will respond to you or have somebody from my office respond to you. If you guys go read the question and answer sections from the website, we have a lot of those questions already answered. So that's the FAQs, and they're up here at the top of the bar as well. And you can find a lot of these questions have already been asked and answered. So you might want to read those first just to see if your question's in there. Also, if you go to the YouTube video and you watch some of my previous webinars that are more full training, the longer they are, the more training, the more in-depth training you're going to get. You may want to go rewatch those as well. Skip to the section you were curious about and rewatch it there if you didn't get your question answered today. So thank you guys so much for participating today. I really appreciate it. I hope you have a fantastic weekend, and give us a call if we didn't get to you or didn't answer your questions. Thanks so much.